Today, we're going to talk on why you are probably overpaying for insurance in Malaysia. Most Malaysians are buying the wrong insurance and is putting their family at serious financial risk. Here's what you need to know before you sign another policy. The single biggest mistake Malaysian makes are actually your agent promise you'll get all your money back in 20 years plus dividend. If that sounds familiar, you have likely fallen for the most common insurance trap in Malaysia. What you think you actually bought is a savings account plus protection rolled into one. What you actually got is actually a high fee, high rising cost, and dangerously low coverage. The investment linked policy ILP sounds great, isn't it? The ILP in Malaysia is Malaysia's most popular insurance product. One premium buys you life coverage and an investment fund, but math rarely works in your favor. There's actually a high upfront fee. A huge chunk of your 300 ringgit perhaps goes to your commission and also for management fee before a single cent hits your investment. Coverage cost also rises with age. If the return doesn't keep up, then the policy may lapse exactly when you need the insurance the most. So the golden rule is that to never mix insurance and investment. These two financial tools serve completely different purposes. Combining them is like using hammer to screw in a light bulb. It might fit, but it won't work well. So insurance-wise, it's actually to protect you from financial ruin when the worst happens. Cheap, transparent, and focused. Whereas investment grows your wealth over time. Should be managed separately for maximum return. Rule of thumb, if your agent, life insurance agent, is talking about cash value or dividend, you are being sold an investment-linked policy. Ask for term life instead. So what are the solutions? What you should actually buy instead? Ditch the ILP, build your protection on 3 separate pillars, each designed to do one job exceptionally well. Medical card, as charged, no lifetime limit. Why is it non-negotiable? A medical card pays the hospital directly. Look for plans labeled as charged with no lifetime limit. This means you won't be capped at 500,000, 1 million when a serious illness hits. Don't worry about getting your money back if you don't use it. That's what an emergency fund is for, not your insurance premium. So you can actually look at it right on the diagram. There's a S-charge plan compared with a cap plan. So S-charge, you have no lifetime limit, full hospital bill covered, and it's normally recommended as compared to a cap plan where sometimes even in the olden days, it could be even lifetime limit of only 50,000 and some could be 500,000 or even 1 million. And the risk of paying out of your pocket if let's say the lifetime limit has been used up, which we normally don't recommend. Second pillar is actually on term insurance. So this is on term life is a pure version of protection. You pay a low monthly fee for a high coverage, let's say 500,000, 1 million. If you die and become disabled, your family gets the full payout. So it's cheap, a fraction of ILP premium for the same coverage amount, transparent, no hidden fees, no investment funds, no surprises, reliable. Does exactly what it says on the tin. Third pillar, critical illness coverage. Your income safety net. Most people assume that medical card covers everything. It doesn't. A medical card pays the hospital. Critical illness coverage pays when you cannot work. So normally we will recommend you to get at least 3 to 5 times of your annual income as the critical illness coverage. Because living expenses wise, you wouldn't get a single cent from your medical card and it pays directly to you instead of the hospital. So this is the 3-minute audit for your policy. Before buying anything new, check what you already have first, what insurance you have. These are the 3 steps that you can use in 3 minutes and then find out what's the cost of insurance, sum assured, and deductible. If your cost of insurance is rising sharply every year, you're in an investment-linked plan. If your sum assured is under 100,000, you're severely underinsured. Add a deductible to cut a premium by 30 to 50% if your budget is tight. So lastly, buy insurance to protect, not to profit. I would say insurance agents are not the villain, but it's your responsibility to understand what you're buying. Don't choose a product because of cash value at the end. Choose it because it will save your family from bankruptcy if the worst happens tomorrow. Do this. Separate term life as charged medical with critical illness coverage. Avoid investment links that mixes insurance with investment. Coverage get at least 5 times of your annual income for your critical illness. For life, we will normally recommend at least 10 times minimum. So if you have any questions, you have any inquiries, feel free to visit my Linktree or Telegram. I'll see you in the next video.